If 3 to 5 years kind of our time horizon, I think the secular shift to taking on more risk in search of a yield is net positive, net bullish for risk assets.
So bullish, positive outlook, but not basically full throttle because, the market is still fragile and you need some downside protection as well. But definitely positive view.
That's James Nickerson, portfolio manager at Canadian-based Cumberland Private Wealth Management, and Matthew Bartolini, managing director at State Street Global Advisors. We thank State Street Global Advisors for sponsoring the live ETF Think Tank Exchange, as well as this podcast.
This is their Midyear Economic and Market Outlook. I'm Kedar Wilson.
And I'm Michael Venuto. Welcome to the Think Tank Exchange podcast. We have quite a show lined up, Kedar. Matt and James offer market overviews both here in the US and internationally. They share their views on volatility, on valuations, on benchmarks, duration, income, energy, flows, and their thoughts on active versus passive management. We are providing this outlook to help your clients understand the market landscape and achieve their desired investment outcomes.
That's some list, Mike, and great insights for our advisor audience. A note to our listeners, join us for the live ETF Think Tank Exchange shows where you can earn CE credits while learning from our experts.
Our goal in both the live shows and this podcast is to provide thought leadership by bridging the gap between investment producers and the advisors who use their products through actionable ideas.
As you mentioned, Mike, Matt and James are covering a lot of territory in this show, led by our own Dave Armstrong and Dan Weiskopf. So let's not delay and get into this outlook.
Yeah, let's see how the professor and Armstrong do today.
Matt, here as we sit at the middle of the year, you in your capacity think a lot about the markets, both past and future. Can you make some comments about what you're seeing today?
I think it's a confluence of different factors that, part of it is the rising case rates and what does that mean in terms of the recovery and the reopening, whether it's increased mask mandates or some of the restriction of mobility. But also at the same time, there's some other macro factors like the Federal Reserve, seemingly starting to signal maybe tighter monetary policy from some Fed officials, Bullard particularly. So there's sort of just, those macro factors that impacted sentiment. At the same time, more technical factors were sort of setting up for something to shock the system. Even though the volatility index, the VIX, had fallen below 20, this still was a significantly fragile market. And you had market breadth that was not really that strong. You had the S&P 500 hitting all-time highs, yet only about 46% of the stocks within the S&P 500 were trading above their 50-day moving average. That was some pretty weak breadth. So there's a sort of setting up for something to have a bit of a sentiment correction. Now, I think taking a bigger picture is as long as the vaccination rates are outpacing the case rates, the market should continue to heal in this sort of recovery mandate. Economic data continues to be supportive. In our most recent chart pack, we identified, we have about 14 different indicators. All 14 of them are above their above their trough during the pandemic. 11 out of the 14 are above their pre-pandemic. So the economic data continues to support a strong recovery. Then you look at the earnings that are starting to come out. And I think that also played a little bit into this correction. We had a bit of a fundamental vacuum where there wasn't a lot of fundamental data coming out into the marketplace. And now we're starting to have that. Earnings are coming out. Earnings estimates continue to be revised higher. The one concern, though, is that maybe this is the peak of the growth. At the same time, if the Federal Reserve starts to pull the reins back, that's going to lead to a growth shock. So there's a lot of confluence of macro factors that are somewhat unavoidable. But I think the Federal Reserve, as a result of the rise in case rates, will start to sort of pull back on any of that hawkish rhetoric from some of the Fed officials. So in our view, we still are positioning for a more cyclical risk-on type recovery, but not completely eschewing any sort of defensive positioning because you still have that sort of benefit of asset allocation by holding some long-term treasuries. If the market does start to have more volatility, which, and this is the last point I'll make on sort of the opening, we go to August. August is a big tipping point for volatility in my view. And it centers around the Federal Reserve Jackson Hole Symposium. That historically has been a event where the Federal Reserve communicates policy shifts. And I think this will be another one in August where there would be a policy shift likely to be discussed and foreshadowed, particularly as a result of tapering and when you might actually start to see an increase in interest rates. So in our view, this is where you might see some more bond market volatility, but also some stock volatility.
James, so, how do you personally manage through, these periods of time? And it's summertime, right? So it's not unexpected because fewer people around that you're going to see more volatility than usual, especially given all the unknowns. So what are you telling clients about volatility and how you're handling it as a team?
Well, I mean, the reality, and Matt kind of said it best earlier with the overall asset allocation picture. 2021's been tough in regards to just kind of the rotation that you've seen within the market. So our best approach and kind of what we've been doing in our clients' portfolios is really a barbell approach. So having kind of our traditional less cyclical businesses, less cyclical positions that are just more kind of steady eddy, and then augmenting that with kind of more cyclical positions so that we're managing the rotation and kind of the what's working without having to completely overhaul the portfolios all the time, if that kind of makes sense.
Matt, as we think about where James is coming from, international markets relative to the U.S. markets, what have you seen in the developed and emerging markets that you like, and what have you seen that concerns you?
Yeah, so within our global asset allocation portfolios, we're overweight Europe by about 4% to our target weight. In more recent trades, we trimmed our overweight to emerging markets and expressed that risk, right? So we're trying to think about where you're going to express risk in this market. We actually took it in small caps. And I think that speaks to some of the stronger economic foundations in the U.S. and then sort of the cyclical nature of the recovery. Now, of course, small caps in the last 2 days have fallen about 10%. But we shouldn't be so near term because obviously, if we just even look at the price action as we're talking today, the market has started to bounce back a bit. But broadly, we do like Europe over sort of Asia Pacific EM, just because of stronger vaccination rates, increased mobility, earning sentiment is positive, and there's a valuation case to be made there. From an ETF fund flow perspective, we have seen investors sort of gravitate from that perspective as well. I think in the last month, when we look at on a trailing 3-month basis, European flows into European-based ETFs, ETFs focused on European equities, have broken past the 90th percentile on a rolling 3-month basis. So there's some strong sort of buying behavior. Now they're still well below the max assets they've ever had. So there's still some underinvestment just because so many investors left the European region during sort of the Brexit debacle. So we do like Europe for a handful of different reasons, both macro and fundamental.
Matt, how do you think about valuations in today's market?
Yeah, I mean, it's hard to find a lot of value on an absolute basis in the market, whether you look at price to earnings ratios, price to sales. I mean, we always like to take a very composite approach to it because you can mitigate some of the sort of asymmetrical or idiosyncratic factors and say price to sales for different sectors or price to book, particularly within the technology sector. So you definitely want to take a composite approach to it because you might get some corner solutions with one of them. I think just going into it, you just need to understand that where valuations are now, they are elevated relative to history on an absolute basis. But that doesn't mean there aren't relative value opportunities, particularly within Europe. We like that. I said that earlier. At the sector level, financials continue to have strong valuations, but also strong earnings sentiment. And I think that sets up a case, for some potential opportunities within the financial sector. But you really have to look at it on a relative basis and within a composite approach because there can be some stretch multiples when you look at it just through one specific lens, just given the market environment that we're having now. But all else equal, there's really wholly not a lot of absolute value plays out there from a broad macro perspective.
And James, what benchmarks do you look at, and do you pay attention to, what we're doing here in the U.S.?
You know what? When the U.S. catches a cold, the rest of the world sneezes. So absolutely, I mostly focus on U.S. data anyway. So our primary asset allocation tool, completely revolving around U.S. growth and U.S. inflation numbers. Bank of Canada, I mean, they just follow. follow the Fed. So we're very in tune. I kind of echo Matt. The other thing to think about, I mean, you've got two seats on the Fed up for renewal at the beginning of the year. Powell could be looking for a new job, possibly. Reality is, I think you get a shift dovish with the Fed. That's really what this administration wants, so that they can put forth some of their spending plans.
Yeah, and speaking about how to manage duration with the fixed income side of somebody's portfolio, I mean, where do you see that these days, Matt? You know, and James, and James as well. You know, it might be barbell for you.
So yeah, I mean, being underweight duration relative, say, the ag, right? Just a sort of a broader benchmark had in 2021 been beneficial. In the last, say, 3 or 4 weeks, that's been a complete headwind to any performance. I think looking out ahead, the goal of the recovery is for higher growth and inflation, right? That is essentially what is likely to be produced as a result of accommodative monetary policies and still supportive fiscal stimulus. I mean, it shouldn't be lost on anyone that 39 million households are starting to really receive $500 a month in terms of the child tax credit for the rest of the year. That's a sizable amount of fiscal stimulus. You also have some potential for an infrastructure deal. I know there's a potential vote on Wednesday that's unlikely to happen or unlikely to actually result in any sort of approval. We saw some statements come out today from Republicans that they're unlikely to vote for anything on Wednesday because there's no actual bill for them to vote on. They're still drafting it. So if you take all those factors in consideration and the fact that we are still likely to have, you know, really strong earnings growth for the rest of the year, even though it's going to start to go down because of the easy comps are going to be gone from 2020. So if your view is that the economy is going to expand, you're going to have higher growth, inflation is still likely to be above 2% because of some of the pricing pressures, the increase in demand from consumers going back into the economy in a much more forceful way. You know, consumer confidence is still below pre-pandemic levels. Some of the retail sales are still, you know, navigating around those areas. PCE services are still below pre-pandemic levels. So all that combined, the U.S. 10-year yield is basically a reflection of growth and inflation assumptions. And if your view, and it's my view, is that we're likely to have higher growth as the economy recovers, then you should have higher interest rates on the long end, even though the Federal Reserve is going to be keeping rates short or low on the short end. And again, they don't really impact the long end that much. It's more on the short end. So long story short, I would still be underweight duration relative to the broader ag. I would, you know, seek out bond exposures that would mitigate the impact of rising rates and try to strike a balance between that yield per unit of duration, because you can't just buy investment grade floating rate notes because they only yield about 32 basis points. And you're unlikely to see LIBOR increase. So really, you're not getting a sufficient total return. You're not getting a real return. So in our view, we always like, you know, not always, but like right now, we like senior loans for that reason, is that they do have a coupon above 4% and they have a duration below 0.5 years. So we still like those type of strategies to sort of participate in the recovery because you get that credit aspect to it. And it's not as stretched as high yield either. So senior loans, the average price there is around $98. High yield is stretched when you have the average price around 104, 105, and that's in the 99th percentile historically. So from a duration perspective, being underweight duration, I think is still a sound play for the rest of the year, just given the growth dynamics that are likely to come to fruition.
Matt, I want to talk about income with both you and James, because in many ways you guys represent, I think, the two ends of this spectrum. How do you think about generating income in portfolios for investors?
Great question. I think it's a huge issue for retirees right now. Canada, we have a bit of a different tax structure. So we have something called a dividend tax credit. And in reality, our dividend paying names the dividends get taxed at a lower tax bracket. Simple thinking. So we've employed for a lot of our retirees a dividend growth strategy. And so it's not so much the dividend you're getting, as in we don't really care if it's a 6% yield. We're more interested in buying, say, a Microsoft that pays 1.25% or 1%, but is consistently growing that dividend yield. So the idea is at the end of the day, you get a portfolio full of growing businesses that are paying you an income and are growing that income. So if you can get an 8% raise, let's just call it that, an 8% dividend increase every year, it's almost like getting an 8% raise every year. And then that's going to, over a reasonable period of time, in theory, do much better than locking up money for 10 years in a U.S. Treasury at 1.17 or a Canadian Treasury at 1.14. So that's kind of how we're structuring things, especially within our retiree community right now.
Matt, what are you thinking about these days? Where are you seeing opportunities for investors?
Yeah, I'd agree with that. You sort of have to change your asset allocation mix. Particularly within traditional fixed income, you need to break apart either the AGS components and restructure it based on your view of income versus risk. But even then, you're still going to get likely something below, what the break-even rate of inflation is for the next 5 years, which I think is like 2.4, right? So you have to extend to more esoteric, non-traditional bond markets like emerging market debt, like senior loans, like preferred stocks. And, historically, you could have even included convertible bonds, but given how strong the market has been, convertibles, their yield has been suppressed, just given how strong the price performance has been. So you have to just think differently of your bond allocation. And it is the conversation that comes up with our clients continuously. How can I structure a bond portfolio that gives me a real rate of return above what, essentially the break-evens are? And what it requires is basically taking 50% of your portfolio, moving it away from the ag, and allocating into these things that are going to introduce some form of risk. Now, when we think about risk, one of the things that's interesting is, emerging market debt is you're not really taking on, particularly on local sovereign bonds, you're not taking on credit risk. You're actually taking on more currency risk. So you can diversify your sources of risk from that perspective. Obviously, stepping into high yield and senior loans or something like that, you're taking on credit risk. I think in the preferreds market, that's an area that, I think is somewhat underserved within asset allocations, because you are able to get about a 4.5% to 5% yield, and you're actually getting lower correlations or not perfectly correlated to equities and bonds because of the hybrid structure. But I think, speaking to James's comments, within retiree accounts, you do have to start structuring some of that differently by going into more quality dividend growth oriented equities, blue chips that would give you that, income component to it. So rather than just owning, say, 20% into broad-based equity markets, structuring it by owning quality dividend growth companies instead as your equity allocation. So just rethinking asset allocation is a big part of some of the second derivative effects of the pandemic. It has really reshaped asset allocation. And I think those stories of earning 8% on treasuries, one thing actually is kind of lost is that, your mortgage rate was probably around 7.5%. So, there's sort of some cost associated and differences to back then as well. But still, income is just a really hard problem right now. You have to take on some risk.
I wanted to touch on a little bit on sectors and talk to James about energy. I do think about Canada as being an important energy country, right? What are your thoughts about the direction of energy these days? And, where are you positioning your overweighted positions in terms of sectors?
That's a great question. Reality, everyone knows energy's had a real tough 7 years here. A little bit of background, the city I'm located in, Calgary, is a complete oil and gas town. I think as we continue with the recovery and as kind of it becomes harder and harder and harder to have a new project, you actually get a bit of a tailwind with your energy names. It's kind of I'm not sure it's the most popular opinion, but I think that that at the end of the day, the price of whether it be oil or gas continues to go upwards as we have more and more demand for it, as we have more and more of a recovery. And then in reality, as supply kind of tapers off. That being said, exceptionally volatile. So we've actually been structurally underweight energy, especially relative to our benchmark for probably the last 5 years, and have over the last probably 5 months brought that weight up. We're very, very conscious on sector performance at our shop. And the idea is to kind of understand kind of what the undertone of the market is. So when we're looking at some of our indicators, if some are saying be conservative, like they were at the beginning of the year, but when you look at what underlying sectors were doing exceptionally well, financials and energy being two of them, it actually led us to continuing to be overweight and continuing to be aggressive throughout to about May, when we did start taking our foot off the accelerator a little bit. So long term, I do see issues within the energy complex. Next 6 months, though, next year, especially as we kind of continue with the recovery and looking at valuations of it, I do think it's a reasonably attractive place to be.
Matt, you recently did some detailed work on flows. Can you talk to us a little bit about your work on the flows, because that sometimes is telling.
Yeah, I mean, this year from ETF fund flows, it's going to be a record. It's not a matter of if, it's just a matter of how much. I mean, I think right now we're about 490 billion, so 15 billion shy of the record set in 2020. So there's just been a frenetic amount of capital deployment by investors across many different diverse client types. And you see that whether it's a reduction in mutual fund assets and money markets, and so that capital coming off the sidelines. Some of it is a transfer out of mutual funds. So, perhaps it's a net wash. But when you look at beneath the surface, it's been equities driving it. They're roughly, I think, 390 billion or so. Fixed income is likely to break records that they set in 2020. So another back-to-back year of 200 billion. So that just signifies more adoption. But underneath the surface, it's, cyclically oriented equities. Now, in the last 2 weeks, the sort of proverbial foot has been taken off the gas. You have financials and energy, materials, industrials, consumer discretionary, all in outflows this month. But on a longer term basis, they've had a phenomenal run in terms of asset allocation and flows being deposited into them. So there has been this positioning of a very risk-on sentiment of that this is going to persist. The economy is going to recover. We're going to have an expansion. You likely want to target areas with higher expected growth, because even though we've had a bit of a sentiment change in the last 2 weeks, we look at earnings revisions for cyclically oriented equities. They're much higher than sort of defensives. You have expectations of higher earnings growth for cyclicals, and the valuations are lower. So we continue to see, even though we have this sort of 2 week gap, I think the interest is likely going to continue to still be there, just given some of the macro underpinnings, but also the fundamental foundations. Now, within fixed income, it's again, there's been a really strong interest in sort of two areas that stand out. One has been senior loans for some of the topics I discussed earlier about, a yield above 4%, low duration, credit oriented but not stretched. But then, they've taken in, I think, like somewhere in the neighborhood of like $7.5 billion this year, which the numbers in 2021 are greater than the last 8 years combined. So the interest has been quite significant. The other has been tips. Tips have taken in flows, I think, for like 16 consecutive months. And we continue to see investors position for a environment where tips should outperform nominals, because inflationary pressures are likely to be a tailwind. So the flows are just really synonymous of more capital deployment, more risk on allocation, more positioning for a recovery. Now, again, the last 2 weeks have been a bit different. So I'd want to see if this is was a complete turn or just more of a pivot overall for the last 2 weeks, and we start to continue on thereafter.
Matt, do you think the same way? You've written some wonderful stuff about active versus passive relative performance. Do you think the same way about active versus passive?
Yeah, so the factors that we always sort of look at that would be constructive for active performance, particularly within equities, is the pairwise correlation of the underlying stocks and then the dispersion of stocks. You would want a low correlation environment with high dispersion. And that's ultimately what we had up until, let's say, the last 2 months. And that's why some of the active manager performance, particularly within U.S. equity mandates, was really strong in Q1. In Q2, it faded. and Q2 is actually quite poor. Now, the predictive nature of correlation dispersion is rather difficult, right? You basically are looking on an ex post basis. So what we always like to use as a sort of a guidepost for any sort of due diligence strategy. If correlations are low and dispersion is high and your active manager is not performing strongly, that should actually trigger a due diligence question. What is going on here? Is it a poor sector bet? Is it too concentration? And that's how we sort of frame the discussion. Is like, okay, has it been a conducive environment for active management? How is active management done?
Yes.
And what I thought was interesting is small cap growth managers. I forget the numbers. I just wrote a blog on it, but it's the summer months, so forgive me. But they had the strongest performance. And when we looked at it, the top decile, it was a lot from an idiosyncratic portfolio. So there was no factors that were driving it. There was a lot of idiosyncratic stock-specific risk, which is what you would want from an active manager. However, what gave me pause of saying, hey, look, maybe there's something going on here, is that none of those managers, or not none of them, there's a small selection that have been in the top decile in the previous quarter or in the previous 4 quarters. So it seemed to be very, very idiosyncratic, and perhaps that's not likely to persist because maybe a few managers got some specific stock calls correct. There's not a lot of persistence in that performance. So that was sort of the basics of the blog post that we recently wrote, is that the environment became less conducive overall for active management in U.S. equities.
And James, your opinion would matter a lot too in that context, because when do you use an active manager versus a passive manager? And I have to say, I admit I have a bias that, especially with sectors, it can make a huge difference.
Yeah, I'd echo that. I'd sit here and say it really depends on what we want that piece of the overall portfolio to do. I think that active management, not only with the sector biases and being able to tilt sectors, but with downside protection measures, can add a lot of value as well. So people are very, very concentrated on returns, as they should be. But there's 2 parts to the job. There's risks taken on as well. And so if you want to get nerdy, looking at Sharpe ratios and things like that is a fantastic way, in my opinion, to pick an active manager. It's not everything, but I do believe that active management, in addition to sector calls and tilting, can add a lot of value on protection to the downside.
I would echo that. I mean, the one ratio that we always like to look at is Sortino ratios, just because volatility can be good. Downside volatility is usually bad. So including Sortino ratio in any analysis, even though you're getting more in depth, I think has always been helpful in my opinion.
Well, you've given us a great macro perspective. Let's see if we can bring this back for our listeners as we bring this to a close. We've covered a lot of territory. I want to do a quick roundtable on whether or not you are net positive on the markets right now, net neutral, or a little concerned. James, why don't we start with you?
I'd sit here and say, one common theme that we've kind of kept coming back to is a chase for yield. Investors are going further and further and further out on the risk spectrum, looking for yield. So I think that's secular. I really do. And that makes me quite positive on risk assets as a whole, looking out 3-5 years. It really does. Now, we might have an accident. I'm pretty certain we will have an accident from now in between that. But if 3 to 5 years kind of our time horizon, I think the secular shift to taking on more risk in search of a yield is net positive, net bullish for risk assets.
Matt, you?
Yeah, on a long enough time horizon, it's always great to be a bull. But in more short term, if we look at even just our own asset allocation, we have about 66% in equities. So definitely positive outlook on the market in the near term, just given what we've seen from recovery dynamics. But we're, even within fixed income, while we have, high yield and emerging market debt, our second largest position is in long corporates, which are basically all duration at this point with a little bit of spread to get yield. So Yeah, bullish, positive outlook, but not basically full throttle because the market is still fragile and you need some downside protection as well. But definitely positive view.
Dan,
you want to take it home? We'll wrap it up. So James, we always like to give our guest, who's a financial advisor, the opportunity to highlight their favorite charity. Can you do that?
Yeah, I have chosen the Pancreatic Cancer Society of Canada. I've had a few relatives pass away from pancreatic cancer, a couple buddies' parents, and I mean it's a disease that has a 95% mortality rate. So it's a serious one, and so that's kind of what I've chosen to highlight.
Well, James, a big thank you to you for joining us today. You've been a wonderful guest and an insightful one at that. Matt, we want to thank you for your thoughts, comments, conversation. Advisors really want to hear about kind of what's over the horizon, and you've done a wonderful job of helping elucidate some of the ideas and opportunities and risks that are out there. So thank you for your contributions.
As we wrap up, we'd like to thank James Nickerson and Matt Bartolini for their insights. And again, we thank State Street Global Advisors for sponsoring the live ETF Think Tank Exchange and, of course, this podcast. We always love to say that our value prop is to enhance yours. And we really encourage all you advisors out there to reach out and learn about the various things we can do to help grow and support your business.
Absolutely. And you can learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and tactics for growth.
That's a lot of think tanks in that last sentence there, Kedar. Well, the think tank is here because our value prop is to enhance yours. So until next time, keep the exchange going. I'm Mike Venuto.
And I'm Kedar Wilson. Take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.